Assalamualaikum warahmatullahi wabarakatuh. Welcome to my video presentation as my final assignment on financial accounting seminar subject. I would like to quickly introduce myself. I am Muhammad Gabril Asade from class of 2017 International Accounting. On this video, I'm going to explain my paper with the title of The Value Relevance of Accounting Information, the Impact of IFRS Convergence. In the next slide, I will show you the background why this topic is important for us to know. I have four main ideas in my background of this paper. First, according to Ball in 2016, accounting is formed by economic and political forces. The integration between markets and politics, coupled with globalization, demands the availability and harmony of relevant information, which makes the integration of financial reporting standards unavoidable. Departing from this phenomenon, the International Accounting Standard Board or IASB developed a set of high-quality financial reporting standards that are accepted internationally, namely International Financial Reporting Standard or IFRS. The second main idea is to harmonize accounting standards internationally. Countries in the world converge on IFRS. The Indonesian Accounting Standard Association in December 2008 announced the convergence of Statement of Financial Accounting Standard or PSAK with International Financial Reporting Standard or IFRS, and this convergence process is fully realized in 2012. IFRS convergence is expected to facilitate growth in the Indonesian equity market. The obligation to use IFRS for a listed company is one of the most significant changes in the history of accounting regulation. More than 100 countries have adopted IFRS. Regulators hope that the use of IFRS can increase the comparability of financial statements, increase company transparency, and the quality of financial reporting so that it can benefit to investors. But until now, there are still differences of opinion about the benefits of IFRS adoption conceptually among academics and practitioners, including in Indonesia. The third main idea, the proponents of IFRS adoption argue that IFRS convergence will improve the quality of information, such as increasing the comparability and transparency of financial reporting around the world, which is expected to reduce the cost of capital for companies. And the last main ideas of my background is research in various countries regarding the value relevance of accounting information after the adoption of IFRS has resulted in mixed conclusions. This paper will provide a picture of the impact of IFRS convergence on the value relevance of accounting information based on the empirical evidences from previous research. The problem statements raised on this paper based on the background I described previously are: what is meant by the value relevance of accounting information? What is the fundamental difference before and after IFRS convergence? The last and the core problem statement of this paper is the value relevance of accounting information higher after adopting IFRS compared to before adopting IFRS. Bart in 2001 explains that relevance refers to the ability of an item to make a difference in the decisions of users of financial statement. Furthermore, Bart defines value relevance as the relationship between accounting value and a measure of a firm value, such as stock prices. If the accounting value significantly explains the firm value, then it is concluded the value is relevant. The value relevance of accounting information is the ability of accounting numbers to summarize so that the value relevance is indicated by a statistical relationship between financial information and stock prices or return. The value relevance is directed to investigate the empirical relationship between stock market values and various accounting numbers, which are intended to assess the usefulness of the accounting numbers in the company's fundamental valuation. Value relevance is one aspect of measuring the quality of accounting information, namely the ability of information presented in financial statement to describe the value of a company. Information in financial statement has value relevance if this information can be used as a basis of predicting market value. The value relevance can be measured by estimating the statistical relationship between the information presented in the financial statement and the value of shares in the market. Testing the relationship between accounting information and stock value can be done by using two types of valuation models, namely the price model and the return model. Both models are derivative of the same theoretical foundation, namely the linear information model developed by Olson in 1995. The price model is economically better to use than the return model because it can estimate the value of the unbiased slope coefficient. Another advantage is the possibility to examine the value relevance of book value and net income variables. Also, price model is used to prove the relationship between accounting information and prices or changes in the stock prices. This model basically connects to the market value of the company, which is stated in the share prices. With the company's earnings and book value and other information that can affect the value relevance of accounting information, there are two ways in estimating the value relevance. First is by using written model, and second by using the price model. Written model, the relationship between intrinsic value and stock market price can be measured using the written model. The written model is a mechanism for changing a series of economic variables or company variables that are predicted to become estimate of stock prices. The written model can explain this relationship, which relates accounting earnings or profit as the intrinsic value of shares to the stock price or return itself. And the second, price model. The pricing model uses stock prices, which are used as the dependent variable to assess the usefulness of accounting information. The pricing model introduced by Olson in 1995 explains the relationship between stock prices and book value and accounting earning as well as other information that may affect the value relevance of accounting information. Before adopting IFRS, Indonesian accounting used historical cost for measuring transactions. Historical cost is the amount of cash or cash equivalents paid or the fair value of the other consideration given to acquire an asset at the time of acquisition or construction, or if applicable, the amount that is directly attributable to the asset when it is first recognized in accordance with certain requirements in another BSAK. The weakness of historical costs is that they do not reflect actual condition. The advantage of historical cost is that historical cost is more objective and more verifiable because it is based on transaction. However, management can take advantage of the weakness of historical cost to manage earnings. For example, when the company's performance is poor, if the fair value of asset at the reporting date is greater than its value, then the management will sell the assets so that any gains are recognized in the income statement. IFRS standards tend to use fair value, especially investment property, some intangible asset, financial asset, and biological asset. Thus, competent resources are required to calculate false value or even hire an appraiser consultant, especially for assets that do not have active market value. Fair value is an amount that can be used as the basis for the exchange of assets or settlement of liabilities between knowledgeable and willing parties to make arm's-length transactions. The advantage of using fair value is that the asset and liabilities held are more representative of their true value at the date of the financial statement. However, there is an argument against the use of fair value, which states that the use of fair value causes volatility in financial statement and reduces prediction of earnings. However, if the use of fair value causes high volatility, it actually only reveals the true economic reality. Thus, the transition from historical cost to fair value is expected to reduce earnings management by the company. And then, prior to convergence to IFRS, accounting standard in Indonesia use USGAAP as formulated by the FASB. USGAAP is a rule-based standard. A rule-based standard will improve consistency and comparability between companies and over time, but on the other hand may be less relevant because the inability of standard to reflect the economic events of different entities between companies and over time. Rule-based standard will also result in the emergence of accounting standard for certain industries such as toll road operation accounting, cooperative accounting, forestry accounting, and banking accounting. Whereas, in principle, there are similarities to the accounting standard in terms of revenue recognition and asset recognition. The more rules, the more loopholes it will have to break. This results in more and more rules to have cover other gaps. The detailed standards also provide incentive for management to arrange transactions according to the expected result based on the rules in the standard. Auditors also find it more difficult to resist manipulation by management when there are detailed rules that justify them. In addition, detailed standards cannot meet the challenge of changing complex and rapid financial conditions. Detailed standards also present with rules or forms do not reflect economic events in contrast to US GAAP, which is based on the principle of IFRS accounting standard. Regulation at the principle level will cover everything under it. However, the weakness is it will require a fairly deep reasoning, judgment, and understanding from readers of the rules in applying them. This kind of standard is consistent with the purpose of financial reporting to be able to describe the actual event in the company. Principle-based standards provide an advantage in that they allow managers to choose accounting treatment that reflect the underlying transaction or economic events, although the opposite might occur. Principle-based standards enable managers, audit committee members, and auditors to apply their professional judgment to focus more on reflecting substantially on economic events or transactions, rather than simply reporting economic transactions or events in accordance with standards. Based on previous research, it was found that IFRS convergence process had a positive effect on the increasing value relevance of accounting information for companies in Indonesia. IFRS convergence is able to increase the relevance of information on the value of companies' earnings. This means that the ability of earning information in predicting stock prices after IFRS adoption is better than before IFRS adoption. Earnings are used to provide useful information for those with the most interest in financial reporting. But more specific objectives should be detailed to better understand the income statement. The earnings value is often used as a reference by potential investors as a measure of a company performance. Besides earning, it is also considered as a good predictor to help the investor to predict future income and economic events. Based on signal theory, the company provides signal in the form of financial report. More specifically, the value of earning, which will be used as a reference for decision making. If statistically the value of earning is related to stock prices, then the value of earning will have relevance. So an increase in earning will be related to an increase in share prices and vice versa. The impact of IFRS application on earnings reporting in Indonesia is the issuance of PSAK number 1, which cover reporting of comprehensive income. Comprehensive income include profit or loss from non-owner changes in net income to be presented in the financial statement. By including OCI in net income, comprehensive income will increase the value relevance of company's financial statements earning. There is an increase in the value relevance of the earnings value of financial statement because it is in accordance with the theory of the efficient market hypothesis. When the quantity and the quality of earning increase, the value relevance of earning will also increase. This is because investors can make more informed and quality decisions. Besides increases the value relevance of accounting information, IFRS convergence also increases the value relevance of company cash flow information after adopting IFRS compared to before adopting IFRS. This means the ability of operating cash flow information in predicting stock prices after adoption is better than before IFRS adoption. Operating cash flow are the main income generating activity, and other activities that are not investing and financing activity. PSAK number 2, paragraph 12 describes the importance of operating cash flow as an indicator that determines whether the company's operation can generate sufficient cash flow to pay off its obligations, such as loans or liabilities, maintain the company's operation, pay dividends to investors, and make new type of investment without relying on outside sources of income. The purpose of presenting operating cash flow is to provide relevant information about the receipt and disbursement of cash or cash equivalent from a company in a certain period. The value of operating cash flow will have relevance if statistically the book value of equity is related to its share prices. So an increase in book value is related to an increase in stock prices and vice versa. The amount of cash flow that comes from operating activity is an indicator that determines whether from its operation, the company can generate sufficient cash flow to pay off loans, maintain the company's operating capability, pay dividend, and make new investment without relying on outside sources of funding. So that an increase in company cash flow, operating activity will give investor a positive signal about the company's future performance. As a result, investor will buy shares of the company, which in turn will increase the share prices. However, information relevance of book value of company's equity is not higher after adopting IFRS than before adopting IFRS. This means that the ability of equity book value information in predicting stock prices is not a significant difference between before and after the company adopted IFRS. Book value per share is the value that shows the net asset owned by shareholder by owning one share. Net assets are equal to the total shareholder equity. So book value per share is total equity divided by the numbers of shares outstanding. If statistically the book value of equity is related to the stock price, then the book value will have relevance. So an increase in book value will be related to an increase in stock prices and vice versa. Many countries' results show that adopted IFRS significantly improve value relevance of accounting information, especially on earnings and cash flow information. IFRS has improved value relevance of accounting information, which result may be caused that IFRS application, such as fair value presentation of financial report and principle-based approach, would lead to a closer book and market values. We come to the conclusion of this video. Relevant information in the financial statement of company is very important for external parties which need information regarding the real condition of company. The more relevant the information in the financial statement, the easier the company value will actually be known to investors who want to invest their funds in the company. Creditors will also easily analyze the company's ability to fulfill its financial obligation, as well as for suppliers to find out the sustainability of the business relationship with the company as its client. The value relevance of accounting information is the ability of accounting numbers to summarize the numbers in the company's financial report so that the value relevance is indicated by a statistical relationship between financial information and the stock prices or return. The value relevance is directed to investigate the empirical relationship between stock market values and various accounting numbers, which are intended to assess the usefulness of the accounting numbers in the company's fundamental valuation. In order to improve the high quality of financial information on international capital market, a single set of high-quality global accounting standard has been formulated by ISB, known as IFRS. Indonesia, as a member of the G20, is committed to using a global accounting standard. Research were conducted to determine whether implementing IFRS was able to increase the value relevance of accounting information in companies' financial report. Although research related to this matter is very limited, especially in Indonesia, it can be concluded from previous research that implementing IFRS can increase the value relevance of company accounting information, especially on companies' earning and cash flow. But it is not too significant in a company equity information. This means that the ability of earnings and cash flow information in predicting stock prices after adopting IFRS is higher than before adopting IFRS. That's all from my video presentation. I hope you understand this topic. Thank you. Assalamualaikum warahmatullahi wabarakatuh.